Welcome, everyone. Happy Friday. We're going to give folks a minute or two to join. While we're waiting, if you could introduce yourself in the chat and let us know where you're coming from. Welcome, Aisha, Concord, California. Liz from Nebraska. We have Austin, Texas, Chicagoland area, Sacramento, Monterey. Wow, a lot of California in the building. Good morning. Happy Friday. Pennsylvania, Nevada, Boston. I'm in Providence. Amazing. We're going to give folks one more minute. We'll jump in. We do have a lot to cover today. Very excited that you're all joining us. Tennessee, North Carolina, Montana. Shout out to Montana. Amazing. One note here before we do jump in, if you open up the chat in Zoom, you'll see it says two, and you're able to select host and panelists or everyone. So if you do want to chat with everyone, make sure you change the settings. I think it defaults to host and panelists, so we're the only ones who see it. So go ahead and change it to everyone. We're going to go ahead and get started. We have 750 therapists who signed up for this webinar, which is just incredible. We have 133 live. Thank you so much for being here. If you're watching the recording, thank you so much for tuning in. I expect the number will go up over the next few minutes here as folks join. Today, we're going to be talking about how to navigate quarterly taxes as a therapist. There are a lot of benefits to self-employment, primarily working for yourself, setting your own schedule. But the downside of self-employment is paying self-employment tax. And if this is your first year in private practice, how to navigate paying taxes when you've never had to do it before can be very confusing. It can be overwhelming. And that is why we are here today. And it's also why HERD exists, to make this whole process easier for you as a therapist. Just a couple housekeeping items here. We will be taking questions throughout the webinar. It makes it way more fun and engaging for us as presenters if you do ask questions. A quick disclaimer, we may not be able to answer your particular question, especially if it's about your unique tax situation. That is a great question that our tax experts at HERD can answer for you if you do decide to join HERD and become a member. But please drop your questions in the Q&A. There's now 151 folks on this call. So if you drop your question in the chat, it's just going to get lost. If you look at the bottom of your window, you should see two chat bubbles with Q&A. So drop your question in there. Jonathan's going to be manning the Q&A, and we'll stop throughout to take questions. This is also being recorded. So if you join late or if you have to leave early, don't stress. We'll send the recording to you. We'll also email out the slides, so don't feel like you need to take notes. Quick warm-up question here. Have you made quarterly tax payments yet this year? Drop a 1 in the chat if yes, a 2 if no, a 3 if not every quarter, and a 4, what's a quarterly tax payment? It's okay, you can be honest. Great, good mix here. Bunch of 2s, some 1s, that's great. Some 4s as well. So a good mix of folks. If you're a 4, by the end of this hour, you're going to know what a quarterly tax payment is. When we think about taxes, we think about tax day being April 15th, which is when you file your tax return. Everyone in the United States has to do it. You may think of tax season as April. If you have friends who are CPAs or accountants, they get really busy for like 6 weeks and you never see them. But I want to present a reframe that tax time is really all the time when you're a business owner. It's not just once a year when you pay your taxes. What do I mean by that? How you manage your finances on a monthly basis, how you pay yourself, how much money you set aside for taxes every month is important. Are you paying taxes quarterly, which we're going to talk about? And of course, annually when you file your taxes, also very important. But really, taxes are a year-round thing. It's not just once a year thing. What is Herd? So folks who are, for folks who are unfamiliar with Herd, we are the accounting platform for therapist entrepreneurs. We're super passionate about empowering therapists as small business owners through financial software that's easy to use. And we also provide access to bookkeeping and tax professionals. So you can really focus on the work that you want to do, which is helping your clients, not all of this financial stuff. We are excited to be able to share a special offer. So just for folks who have registered for this webinar, we're offering 15% off our annual plans. And so if you're unfamiliar with our pricing, if you are a solo therapist in private practice and you're taxed as a sole proprietor, so if you have an LLC, our plans are $199 a month. And that includes monthly bookkeeping, quarterly tax estimates, which is what we're talking about today, as well as annual tax filing. We do offer 15% off for annual billing for everyone. So just for folks on this call, we're offering an additional 15% off, which gets that monthly cost from $199 down to around $140. So it's a really great deal. If you're interested in Herd, we do offer free consultation calls. If you just scan this right here, fill out the form. I recommend even doing it right now just because we have a limited number of spots. And as I mentioned, there was 750 people who registered for this webinar. So grab one of those consultation spots if you're interested. We are only able to offer this until Wednesday of next week, just so we make sure that we have enough time to get your quarterly tax estimate to you before the next payment deadline, and also so you have enough time to pay. So again, pull out your phone, scan this really quick, fill out the form, grab one of those spots before they're gone. Melanie is going to drop that in the chat as well. Thank you. Great. So really quick, my name is Michael. You may have seen Michael from Herd in your inbox if you're in our Facebook group or if you've tuned in to our new podcast, Herd Business School. I've been with Herd for over 2 years now, and I've spent the last 12 years working with therapists, supporting them as business owners. I'll let Jonathan quickly introduce himself as well.
Hey everyone, I'm Jonathan Meneses. I'm based in Austin, Texas, and I work on the Herd product team. I think a lot about what are the tools and processes that we need to build to help make the tax experience for therapist entrepreneurs as easy as possible. I have a background in building clinician-facing patient care tools for therapists and behavioral health providers. But excited to make this transition into a bit more of the financial part of the business, as I think there's a lot of less compelling tools in that space here.
This is a very busy time for us as we prepare for this upcoming quarterly tax deadline. So really grateful for you, Jonathan, for making the time to be here. Melanie from Herd is also on the call. She is in the chat, so say hi to her. Really grateful, Melanie, for you being here. Great. So what are we going to be covering over the next 50 minutes? We're going to be talking about who has to pay quarterly taxes. We're going to talk about why you have to pay quarterly taxes. We're going to talk about how much to pay, when to pay, and what happens if you don't pay. So these topics come directly from questions that we get all the time from therapists, both therapists that are members of HERD, but also therapists in the larger community. So the first question, do I need to pay quarterly taxes? This is a big one, especially if this is your first year in private practice. You may have heard of quarterly taxes. Maybe you are in Facebook groups where people are talking about it, asking questions. The IRS guidance when it comes to who needs to pay quarterly taxes is very clear. If you expect to owe $1,000 or more in taxes, you are required to make estimated payments quarterly. Full stop. But Michael, can I just pay my taxes when I file at the end of the year? Maybe you've heard that. Maybe your accountant has even said, it's fine, don't worry about it. You can just pay your taxes when you file. Two things there. If you owe more than $1,000 at the end of the year when you file your taxes and you haven't paid in quarterly, you are probably going to pay a penalty and interest on that penalty. Are you going to go to jail? No. You are not going to be in legal trouble with the IRS. You just may have to pay a penalty when you file. So if you can avoid it, great. The other reason why paying quarterly taxes is really important as a business owner is that it helps to manage your cash flow for your business. Essentially, what you're doing is you're taking, and we're going to talk about this, taking what you owe in taxes and you're just splitting it up into 4 payments throughout the year. So you're paying in 4 times a year. When you go to file your taxes, if you've estimated correctly, you're good. If you've overpaid and overestimated what your tax bill is going to be, you'll get money back. If you've underestimated, you may owe a little bit when you go to pay your taxes. But the alternative is I don't pay during the year, and then when I go to file, I owe everything all at once, right? So it ends up being like a really big tax bill. So there are advantages to spreading it out during the year from a cash flow perspective beyond just avoiding penalties. So again, just to be very clear, if you expect to owe $1,000 or more in taxes for the tax year, you're required to make estimated payments. If no, you're not required to make estimated payments. Before I move on, I want to see, Jonathan, are there any questions so far?
Yeah, I think one question that came up a couple times is, are quarterly taxes the same for both federal and state? Or if I pay my federal quarterly taxes to the IRS, do I also have to pay state quarterly taxes? Happy to answer that one. Or Mike, if you want to go ahead and take that, that's great too.
Yeah, definitely. So we're going to talk about that when we get to, how to calculate how much you owe. So maybe we'll put a pin in that. But yes, if you owe, federal estimated taxes, you're probably going to owe state estimated taxes as well if your state has state income tax. And then just to be super, super clear, this 1,000 number is not your income. It's how much you're going to owe in taxes. And so we're going to talk about how to calculate what that number is.
And then one note here as well, every state has different rules as far as whether or not you will owe or are required to pay quarterly taxes. We do have a great resource on the HERD website that talks through that, but you'll come up and see this thing where if you see clients in multiple states, there's different rules for when you should pay quarterly taxes or are required to file taxes in states where you might be seeing clients remotely or traveling to see them in person. That's a bit more of a complex topic than we can tackle just one by one for each 50 states. But the recommendation here would be for your home state, check your Department of Revenue website. Also, you can use HERD's resources on our website. if you see clients in states outside of your own home state, check that Department of Revenue state as well. That's where things might get a little bit more complex for what we would call a multi-state return in this case.
Great. Yeah, we'll talk about that too in a second. We have an example for that one. So great, we've established who needs to pay quarterly taxes. If you expect to owe $1,000 or more in taxes during the year, you're required to make estimated payments. Why do you have to make these payments quarterly? The short answer is the IRS says so, but the longer explanation is that when you are a W-2 employee, so if you're an employee of an agency, of a group practice, of a hospital, every time that you get paid and you get a paycheck, taxes are withheld from your paycheck. Your employer is also paying into things like Social Security and Medicare. So you are not required when you're an employee to make these quarterly payments. Your employer is. They submit quarterly payroll reports and other reports depending on the type of business during the year. But as an employee, it's relatively straightforward. If you've been an employee, you know that at the end of the year in January, you get your W-2 from the previous year. You either give that to your accountant, they file your taxes for you, or you go on TurboTax, you punch in the numbers, and depending on the taxes that were withheld from your paychecks during the year, you may get a tax refund, which is nice, or you might owe taxes, but it's pretty straightforward, right, as an employee. When you're self-employed, going back to what I said in the beginning, you're responsible for reporting your income and also paying taxes on that income. So everyone owes federal income tax. Most states have state income tax. And when you're self-employed, you're also responsible for paying self-employment tax. And this is a big one for therapists who are in private practice for the first time, who aren't used to paying self-employment tax. It's 15.3%. That covers Social Security and Medicare. This is called your tax liability. So what you owe in taxes, remember, if you owe $1,000 or more in taxes, that is also called your tax liability. And that's important. So remember that. So we've established why you have to pay this. How much do I have to pay? This is probably the most common question that we get, right? Because it's also the most confusing. So there's two ways to calculate how much to pay in quarterly taxes. And we'll try to break this down in a very simple way. So the first option that you have when it comes to calculating how much to pay in quarterly taxes is to look at your previous year's tax return. So as long as you cover 100% of your previous year's tax liability, or if you're a high earner, which is, correct me if I'm wrong, Jonathan, $150,000 or more in income, you are required to pay in 110%. As long as you're paying in to cover your tax liability from the previous year, you are not going to pay an underpayment penalty when you file your tax return. So what this is doing is you're basically avoiding penalties and interest if you're just covering your previous year's tax liability. This is called meeting safe harbor. Now, the issue with this is that if you weren't in private practice last year, this may not be all that helpful, because if you're just meeting your tax liability from last year, but you made a lot more money this year, then when you go to file, you're going to have a big tax bill. The opposite is also true. If you made a lot more money last year and this year you made less, if you're paying your previous year's tax liability, you're going to pay way more than you need, right, in quarterly taxes. You're going to get that money back, but you won't have access to that cash during the year, right? So option one, this is a great option for folks who have predictable income. If you've been in private practice for a while and you know every year I make around the same amount, I can just use my previous year's tax return. If you have filed your taxes with an accountant, they may have provided you with vouchers or slips for your quarterly taxes. They're following this method typically. They say, great, your tax return from the previous year, this is what your tax liability was. We're just going to divide that by 4. As long as you make those payments, you're good. The other way to think about it is not looking at your previous year, but actually looking at the current year. And so as long as you're meeting at least 90% of your current tax year liability by the time you file, you're going to avoid underpayment penalties. So the big question here is, okay, Michael, that makes sense. How do I calculate what my tax liability is, right? Because when we think about quarterly taxes, it's how much you owe, which is your tax liability, essentially divided by 4, and you're making those payments. So before we get into how do I calculate my tax liability, any questions on this?
Think as we're looking at the chat here, a couple questions about, what if I start my business midway through the year? How do I think about the deadlines? There's some questions about what are the deadlines to pay, which we'll talk about those a little bit later. But maybe just a question here that we can start getting ahead of is, what if my business started just a month or two ago? When should I start thinking about quarterly taxes? And I think an answer that we can think about there is, it's a good time to start today if you have started your business just in the past month or so. Really, the way that Michael and I kind of talk about this together is quarterly taxes are helpful checkpoints in thinking about what do I think that I'm going to make through the year. Now, if you haven't had any revenue from your business for the last 6 months, as you are thinking about what am I forecasting for my revenue for the rest of the year, you're just starting with a lower amount or sample size for what you think. But as you think about getting through this year, because quarterly taxes are on all of your personal income that comes through, really you can look at it and say, okay, if I think that I am going to make, let's say just for these figures, $50,000 this year, and we're 75% of the way through the year, the IRS would like me to have paid taxes on, 3/4 of that $50,000 at this point in the year. And it's a little complicated talking about this, without an example. So this is going to be a really nice thing to look at in just a second here with this example. But would recommend if you think that you're going to owe $1,000 or more at the end of the year, regardless of when you start your business, when you start earning revenue and income in your business, you should start thinking about quarterly taxes then.
Something I'll add here is that these are estimates, right? It's your best guess. It's really difficult to know what your total income is going to be. And as we get into this, I'm getting ahead of myself a little bit, but I think my point here is like, give yourself some grace. No one teaches you this stuff. You don't learn how to do your taxes in graduate school to become a therapist, right? These are quarterly tax estimates. You're making an estimate on what you think you will owe. And if your estimates are off, that's okay. Don't beat yourself up about it. As you do this longer, you'll start to understand how the process works better. So if this is your first year and this feels really overwhelming, that's totally normal. Like I said, the longer that you're in practice, the more predictable your income is, the easier it becomes to estimate your taxes. It's understandably challenging when you haven't done this before, so you don't know how much money you're going to make, right? And so with that said, this is what we do at Herd. We live and breathe this every day. So we are here to support you, whether you decide to become a Herd member or not. We have a bunch of free resources as well that Mel has been sharing in the chat. Great. So
Mike, maybe we can just pause 1 second here. I want to just help clarify a question that I think I've seen come up that we covered
sure.
earlier, but this concept of, am I paying taxes for my business or am I paying taxes for myself? That I think it's good to
Good
just
question.
clarify here. For most therapist entrepreneurs and most of our Herd clients, what you are working with as a tax entity is what's called a pass-through entity. And this is going to be the case for the vast majority of therapists that are starting their own practice or working as a contractor. In this case, your taxes or your income from your therapy business passes through you or passes through the business to you as personal income. And so it actually simplifies this process quite a bit in that you're not having to pay business specific taxes externally on that income. You're actually then just going to take that practice income and show it on your personal tax return. So it's really not all that different aside from the accounting pieces and the deductions that you can think about in this process and some additional fees, but it's really not that different than just thinking about this is new income that I have earned, through maybe my normal job or other areas. The big difference here is that you haven't paid taxes on that regular basis through an employer covering that. So that's just something to think through here as we're going to talk through this calculation, is this business income comes through to you as a personal income on a tax return.
That's a great point, Jonathan. I remember when I started my own business, I thought about my business income and my personal income as separate, and that if I didn't move money from my business to my personal checking account, that money was just in my business and I wasn't taking that out, so it wasn't income. But if you are taxed as a sole proprietor, which most therapists are, if you form an LLC or a PLLC, you form a business entity, that is a legal entity. It's not a tax entity. So you're still a sole proprietor. So you're paying taxes on the money that you're making, whether it's in your business account or it's in your personal account, you're reporting that as income. So that is a really great point. And then just not to get off topic here, but when you do file your taxes, everyone files a personal tax return. It's a Form 1040. If you work with an accountant or CPA, that's what they file. You report your business income from your practice, your self-employment income, on a form called Schedule C, and that's submitted with your 1040. So that's how it works when you actually file and kind of where the like business and personal income, but it's your Form 1040, your personal tax return. It gets submitted at the same time. Great. So I want to move on here. How do I calculate my tax liability? We know that, again, if my tax liability is $1,000 or more, I'm required to make estimated payments quarterly. So how do we know if our tax liability is $1,000 or more? The most helpful way, I think, to explain this is by walking through a specific example. So you are a therapist, you're a sole proprietor, you live in Georgia. So shout out to the state of Georgia if there's any Georgia therapists here. You're filing single, you have $100,000 in annual private practice income. So for simplicity, we're using round numbers in this example. So the first thing you need to do is you need to calculate what your net income is going to be. So let's be very clear. If I make $100,000 for my private practice, I don't pay taxes on $100,000. I pay taxes on my net income, which is that $100,000 minus any expenses. So I pay for an EHR, I pay to be part of memberships, I pay for CEUs, I pay for an office space. All of these business expenses lower your profit, which is also your net income. You may also hear taxable income. All of these words mean the same thing. The takeaway here is that what you pay taxes on is your income after your expenses. So this is very important. This is also why bookkeeping is very important, which is the process of tracking and categorizing your business expenses, which is a service that we offer at Herd. So step one is you look at your gross income. So how much total income are you making? And to be also very clear, this is your self-employment income, right? So this is from your private practice. You take out your expenses. These, again, are estimates, right? This is your best guess at what you think this is going to be. An easy way to think about this is look at it on a monthly basis. Like, what do you think you make in a month? What are your expenses per month? And then you basically multiply that by 12 to get to an annual number. So for the purpose of this example, you make $100,000, you're projecting to make $100,000 total income. You have $20,000 in expenses, so your net income is $80,000. We're going to do some math here. So stay with me. We're going to keep this as simple as we can. So I mentioned earlier, you're responsible for paying federal income tax. Most states, you're going to pay state income tax. You're also going to pay self-employment tax. So when it comes to federal income tax, you may have heard of the concept of a tax bracket. I'm going to explain in the next slide what your effective tax rate is when it comes to your federal income tax. Essentially, in the United States, we have what's called a progressive tax system. And so as you make more money, you are taxed at a higher rate. But in this example, at $80,000, our effective federal tax rate is 15.8%. Georgia state income tax, 5.49%. And then that self-employment tax we talked about, which is a tough one to swallow, right? 12,240. So in this example, our total tax percentage on what we owe in taxes is 37%. Typically, what we see with therapists is like between 30 and 40%, depending on where you live. If you're in a state with lower or no income tax, you're going to owe less. State like California has a much higher state income tax. So it really depends on where you live and also how you file, right? So in this example, and we're going to talk about this in a second, I'm filing single, it's just me. If I'm filing jointly, I'm going to be bumped probably into a different tax bracket, right? So great. So 37%, which is about $29,000. So that is our total tax liability on $80,000 in income. Drop a 1 in the chat if you're still with me. Okay, great. Thank you. Awesome. Someone put 1/2. So thanks for being honest. Great. So we're at $29,000. All right. Just really quickly, because I think it's helpful when we talk about federal taxes, like how do I get to this number of 15.8%? Like this doesn't make sense to me. If you look at the tax brackets based on filing type, you might think, oh, at $80,000, my federal tax rate is 22%. But that's not how it works. The way that it works is that the money that you earn, and these numbers may seem arbitrary, but this is what the tax brackets are. The money that you earn up until $11,600 is taxed at 10%. Then the money that you earn between $11,600 and $47,150 is taxed at 12%. And then the money that you earn above $47,150 to $80 is taxed at 22%. So you basically just do the napkin math here, right? Like you take 11,600 times 10% plus the difference here times 12%, and then the difference here times 22%. So that's how we get to this number of 12,640, which when we divide that into 80,000 comes out to about 16%. Great. Question here, how do we find our state tax rate? It's online. If you just Google the state that you're in, state income tax rate, you should be able to find it. Great. So based on this math, that it feels complicated, but it's actually pretty straightforward, right? We get to this number of 29,272. Again, this is an estimate. This isn't exact. This is what we think that we are going to owe based on what we think we're going to make minus the expenses that we think we're going to have, right? So it's your best guess. Then if we break it down, 29,702, excuse me, numbers are hard. 29,272 divided by 4 gets us to about $7,500 a quarter. And then if we think about, okay, well, every quarter I'm going to pay in $7,500. How much should I be setting aside every month so that I have enough saved to make that payment? 7,500 divided by 3 is 2,500. So as long as I am setting aside $2,500 a month, $2,500 every month, I'm putting it in a separate savings account. I'm not touching it. When it comes time to make those quarterly payments, I have that money, I make the payment, I'm good. Where folks get into trouble is if they're not setting aside money on a monthly basis. So then when it comes time to make those payments, they don't have access to that cash. I've been in that situation where I wasn't setting money aside for taxes. And then once I got to file at the end of the year, I owed a huge tax bill. And that was a huge surprise. And that's tough, right? Like, we don't want to be in that situation where we owe a bunch of money all at the end of the year, especially if we're not setting money aside. Also, to be very clear here, we're using simple math. This is a very simple example. This $80,000 of taxable income does not include deductions, credits. Say I contribute $5,000 to a 401k or a SEP IRA. That's going to lower my taxable income, right? So there's ways that you can optimize your taxes, which we're going to be offering a follow-up webinar to this one next month on how to get this number down. So this is likely a conservative estimate, right? We'd rather overestimate, and overpay these payments and get money back, because then it's like getting a tax refund or like a bonus you weren't expecting at the end of the year, right? As long as you're not grossly overestimating, because then you're putting yourself in a situation where you can't pay your bills because all of your money is going to these tax payments, right? So we'd rather overestimate than underestimate. If you do want to try to be more exact and account for these types of deductions, you're able to do that. It just makes the process a little bit more complicated. So the way that Jonathan and I like to talk about it is taxes are already complicated. Like, let's just try to keep it as simple as possible. And so the takeaway here, right, is like $2,500 a month. I'm just putting aside when it comes to pay quarterly taxes. I have that money. I'm making that payment. Then when I go to file, as long as my income is where I thought it would be, I'm good, stress-free. Anything here, Jonathan, to add?
Yeah, no, I love that framing. Like tax season is not fun, and why do it 5 times a year if you're going to do 4 quarterly payments and annual tax season? As Michael said, these are estimates. There's a good sense of the effort you put in is kind of the quality of the outputs that you get out here. But because these are estimates and you've got that range where you're looking to be within that, 10% range of what you're paying for the year, we really recommend, not to do a full tax return at each quarter, but rather, take some intentional stock of how is my business doing? What do I think this year is going to look like? And then think about these like large deductions or kind of the complicated calculations during the annual tax season. That way you're not being overly aggressive with what you think you're going to deduct, because then that would maybe result in a case where you have a little bit of a surprise bill if those deductions don't quite work out how you're thinking. So in this case, we think give yourself some grace, give some padding on this, but also know this is supposed to be something that you do, not like a full annual tax return. And if that's the thing that we can take away from here, I think that's going to be really helpful in making sure that you move through this and make this manageable and approachable.
Yeah. Great. So you might be thinking, Michael, that example was very straightforward. What if I am taxed as an S corporation, not as a sole proprietor? Or I have a W-2 job and I have 1099 income, or I filed jointly with my spouse. So each of these circumstances changes how taxes are calculated, right? And so if you've heard you need to set 30% aside, like everyone has a different tax situation, right? So there's no like one rule or one number. We say 30 to 40%, but typically what we'll tell therapists when they ask, well, how much should I be setting aside for tax? It depends. And that's really not helpful, but it's true, right? It does depend on a variety of factors. So, um, Jonathan, do you want to kind of walk us through each of these scenarios kind of at a high level? So starting with, if I'm taxed as an S corporation instead of a sole proprietor, like how does that affect how I make these payments? And do I even need to pay quarterly taxes if I'm set up as an S corporation? And if you are an S corporation, drop a one in the chat. Would love to know if there's any S corps here today.
Okay, awesome. See a
Great, got a
couple
few.
S
Okay.
corps coming in. Thanks, Mike. Yeah, so if you're an S corp, that's great. The S corp tax entity is a really great way to think about maximizing and optimizing your tax scenario. Want to be clear here, we are not recommending that everyone become an S corp. In this, it's a very personal decision. It's a little bit like Uncle Ben and Spider-Man. With great tax benefits comes a little bit more responsibility. Here is kind of how I would think about it. Where you have access to more mechanisms to save on taxes if you're an S corp, but those mechanisms means there's more things that you must do throughout the year. So without getting into all of this, as an S corp, you will have to pay yourself through payroll as a W-2 employee. Taxes are withheld on that amount that you are paying yourself. But with any income that is left over or profits that are left over after those payments, you can take distributions on that income. That still is going to pass through to your personal income. There are some benefits that you don't have to pay certain taxes on that income, but you will still see that as personal income that you're not withholding taxes on because you're not paying that through the payroll process. So quarterly taxes still do apply for S corps for that additional pass-through income that hits your 1040 return. Um,
I think it,
Secondly, yeah, go ahead,
yeah,
Mike.
I might just gonna jump back in here and just show in this example, it might be helpful for folks to just visualize, right? So in this example, we're taxed as a sole proprietor. So we're paying 15.3% self-employment tax on $80,000, which is $12,000, right? We pay $12,000 in self-employment tax. If we elect to be taxed as an S corporation instead of a sole proprietor, as Jonathan mentioned, we set up payroll, we pay ourselves a salary. Essentially, we're taxed as an employee of our own business. So now we're no longer technically self-employed. And so we pay payroll tax on our payroll, which is our salary. So typically a benchmark for a reasonable salary is 50%, around 50% of your income. So we put ourselves on a salary of $40,000 a year. That means we have $40,000 left, right? So of that $40,000, we're able to just take out of the business. We don't pay self-employment tax on those owners' distributions because we're both the owner and the employee in an S corporation. So one way to conceptualize it is essentially you're paying self-employment tax on $40,000 instead of $80,000. So you're saving as an S corporation, in this example, $6,000 a year in taxes. So it can be an advantageous tax strategy. Definitely talk to a tax professional because there are also expenses with being taxed as an S corporation that can be in the thousands. So just want to be careful before you go down that road. And we have a S Corp webinar recording on our website in our resource hub if you're interested in learning more. And we also have a bunch of great content on S Corps as well. So I'm going to go back. What
Yeah.
about if I have a W-2 job and then I also have a private practice on the side, or maybe I'm contracted with Alma or Headway and I'm seeing clients that way?
Yeah, great questions here. And let's take these in two slightly separate points here. So if you have a W-2 job, what's nice about that is your employer is taking care of some of the withholdings for you on your paychecks. Now, you want to make sure, as everyone fills out, the forms when you start employment, that you're withholding the right amount from those paychecks. Because everyone that has a W-2 job, at the end of the year, you may still owe or be owed money. You're not going to get that 100% exactly right. But what that does with those withholdings that are already held or withheld is that is actually adding to your overall income. And so, as Mike showed before, that tax brackets, what this does is now you need to consider your total income to say, what is the effective tax rate on my new practice income on top of my W-2 income? So for W-2 jobs, withholding's taking care of you on that, but the rate that you get taxed at for additional income is slightly higher than if you didn't have that W-2 job. Very similar for 1099 income, but now you also have the fact that that 1099 income is not having taxes withheld on it. So you want to treat that very similarly to what it would be for this practice income of paying those self-employment taxes, making sure that you are then thinking about the total withholdings and then treating that as okay, this is things that I need to make sure I'm paying quarterly taxes on as I'm making those payments.
Yeah, it's a great point, Jonathan. We had distinguished earlier, right, between like personal income and business income. Like if it's all part of your private practice, like in this example of like I just work in private practice full time, like those are the same. I think it is important to distinguish between like W-2 income and 1099 income and self-employment income for the fact that with W-2 income, taxes are withheld, but for self-employment income, it's not. So you really want to look at like, what is my total self-employment income? And do I need to pay taxes? Am I at a certain threshold where I do need to make these quarterly payments, right? Is my tax liability over $1,000? And I don't think I mentioned this, but like a typical benchmark that we provide to therapists is if you make $5,000 or more in self-employment income, so it's through private practice, through 1099, if you make $5,000 or more per year, you're likely going to exceed that $1,000 tax liability threshold to make quarterly payments. Again, it depends on your unique situation. Um, to Jonathan's point, like if you're withholding more in your W-2 job, maybe you're going to cover your tax liability from, your self-employment income. So it really depends, but that's a helpful at least benchmark because, if you just started your practice or you're starting your practice later this year and like, oh, I'm not going to make $5,000 this year in private practice, like it's going to be way less than that, then like you're probably okay. So I thought I would just throw that out there. And then what about filing with my spouse? How does that work? Because is our income combined at that point? And how do we think about quarterly taxes?
Yeah, great question. I've seen a couple of these come in that we've answered some of them in the chat, but good to talk about this together. If you're filing jointly with your spouse, similar to how if you had just two W-2 jobs, your income all gets joined together. You're in a new slight, there's different tax brackets for if you're filing together and you have different deductions, but ultimately, your income and your taxes looks the same if you're filing with a spouse. And again, that's because in this case, for these businesses, these are pass-through entities that they are hitting your personal tax return. And when you file jointly with your spouse, you are jointly filing your personal tax returns as well. So something to think about, just similar to where if you have a W-2 job, your private practice income, you want to think about that tax bracket or that tax
Yeah.
rate that you're in. You want to be thinking about that with your spouse of together, how much are we making? And therefore, what is our tax bracket together? That is what your practice income's tax rate is going to be on. Similarly, you want to make sure that you're withholding the right amount of taxes between both you and your spouse. So not to focus too much on what HERD does within our platform or not, but something that people ask is, why am I including my spouse's income and withholdings when HERD is calculating my taxes? That's important because you want to understand and make sure that you know the right amount that you should withhold for the year. That's based on your personal income. But then you also want to make sure that you are withholding across both you and your spouse the right amount of income or the right amount of taxes for that. And so while you're not getting double taxed on your spouse's income as you're doing this, you are making sure that you are withholding and calculating the right rates as you go through this.
Great. A couple questions here. Sarah asked, how do we pay? We're going to get to that next. So hold tight. Brighton asked, W-2 income adds to your overall tax liability. So just to clarify, your W-2 income adds to your total income, right? But taxes are already being withheld. So you're not going to have to pay taxes twice on W-2 income. But the effect of having W-2 income plus self-employment income is your total income is just higher, which may bump you up into a different tax bracket. So that's the impact of that. Josephine asked the difference between a W-2 and a W-9. That's a great question. So W-2 is the form that your employer submits to the IRS and submits to you. You are a W-2 employee. That's why it's called that. It's just the tax form. When you are a W-2 employee, you submit a W-9, which is like, so they can send you a W-2. So that's how it works. Question in the chat, or sorry, in the Q&A from Abby about startup costs. This is a great one. So for new therapists who are paying to build a website, or maybe they're paying, for marketing or other startup costs, maybe business formation, getting an LLC, all of those things are startup costs. Those are in the expenses, right? So remember, you think about your total income and you minus your expenses. Great. I'm going to move on here.
Yeah, and like before we move on here, just
Mhm.
very quickly, just want to answer a couple of questions that quickly came up. Federal and self-employment taxes, are they paid separately? Was a good question that came in. That amount, when you make a payment to the IRS, that is lumped together as you're making these estimated payments. And the calculations that we're showing, that is both the federal and self-employment taxes. You'll see that Mike is, doing a separate line item to show how those add up together, but ultimately they get lumped into your personal tax liability here. And then similarly, Julie asked, so 1099 income isn't taxed. 1099 income is taxed at the end of the day by the IRS, but withholdings are not automatically withheld, or taxes are not automatically withheld on the income that you receive from 1099 checks. So that is why you are responsible for paying quarterly taxes yourself on that. And then similarly, one last question here. What percent is Social Security taxed at? If you're receiving Social Security income, you are liable to be taxed on a portion of that income. This all is very personal based on your tax bracket. So that's something that we're not going to answer here, but Social Security does add to your personal income, at least a portion of your Social Security income.
Great. So how do I pay? Great. We've talked about like who has to pay. I now have a general sense of how to calculate how much to pay. Let's stick with this example, right? I have $80,000 in net income. I'm making, $7,500 in payments on a quarterly basis. Like, how do I even make those payments? How does it work? Do I get a bill from the IRS in the mail? Unfortunately not, because you are telling the IRS, right? Like how much you're making when you're self-employed and you file your taxes, the purpose of that is to report your earnings. And so the IRS makes a lot of things very confusing. By design, they actually make it very easy to pay them. So all you have to do is go to IRS Direct Pay. Again, we will share the slides out, but if you just go to the IRS website, you'll see it. That's where you make your payments. So to Jonathan's point, your federal income tax and your self-employment tax, you pay together. You make those payments 4 times a year. Next, we're going to talk about when those are due. When it comes to state income tax, each state has their own portal. You can pay online. You also, if you would prefer to mail in a check, you're still able to do that, but it's just generally easier to make these payments online. Caveat here is that if you do see clients who live in other states, you may need to report your income that you've earned from those clients if you exceed what's called economic nexus, which is a kind of big word, just that if you essentially make a certain amount of money from clients in that state may require you to report that income and pay tax on it. Every state is different, just like with state licensing for therapists. I looked this up recently. So if I'm in Georgia, I think it was 5.49% is the Georgia state income tax. I'm also licensed in the state of Massachusetts, and I see clients who maybe I used to live in Boston, and I still see clients who live in Massachusetts. The threshold in order to exceed economic nexus in the state of Massachusetts is $8,000. So if I make $8,000 or more from clients who live in the state of Massachusetts, I am required to report that income and pay state income tax on that income. So multi-state taxes start to break down and get a little bit confusing. Every state has their own rules. If you're confused about this, if you think you might owe taxes in other states, you are able to reach out to the Secretary of State's office. Also, you can find a lot of that information on the Secretary of State or Department of Revenue on their website. We are currently working on a comprehensive guide that breaks down state by state what these thresholds are. So keep an eye out for that. It should be out here shortly. So not to like get too off topic, but that's how that works with multi-state taxes. It really just depends on the state. Great. Seen a lot of questions. Okay, when are these payments due? You would think that the payments would be quarterly during the calendar year, but because the IRS likes to be confusing, that's certainly not the case. So the first quarterly payment is due April 15th, calling out that this is the same day that your tax return is due. So this year, if you made an estimated payment, you would pay your first estimated quarterly payment for 2024 by April 15th. Then you'd also file your tax return from 2023. So thinking about next year, just thinking about planning ahead, right? Like it can be a big surprise for folks if when they file their taxes, they owe an outstanding tax liability, and then they're also paying their first estimated payment for the current tax year. So it's like two payments and you're kind of hit twice on the same day. So just keep that in mind. Um, Next payment is it's typically April 15th, June 15th, September 15th, and then January 15th of the following year. The reason that these dates are the 17th is just because it's over a weekend, so it's the following Monday. And so looking at this, there's two ways to think about how do I calculate kind of what these payments are. At Herd, we typically use the annualized method where just because it's easier, is like you estimate your annual income, then you estimate your tax liability, you divide it by 4. Those give you 4 equal payments. The other way to get to it is if you actually use income that you earned during that period, and then on that income, calculating what your tax liability is. So 2 ways to think about it. We definitely recommend the annualized just because it's easier. Question for you, Jonathan. So I haven't paid quarterly taxes yet this year. I'm just learning about this. It's my first year in private practice. Can I catch up at the September 16th deadline, or how does that all work?
Yeah. So first of all, I want to say um, that is okay. It's not a criminal issue to not pay quarterly taxes. I think we get a lot of therapists that are like very worried about that. But you are required to pay quarterly taxes. And if you don't pay quarterly taxes or pay an even amount by these due dates, you may owe penalties on the amount that you do not pay by these due dates. And interest accrues on those penalties if you don't pay down the balance and penalties by a certain period. So if you haven't paid taxes and the due date's coming up for a new quarter, there's a few things you can do. You can pay a lump sum and catch up all at once before the September due date. Or you're not actually limited to just making quarterly payments throughout the year. I think there is someone in the chat that said, I make monthly payments. And that's totally fine. Do what's best for you from a simplicity or a complexity spectrum of what you want to live on here. But if you've missed a payment or if you've missed your deadlines and you haven't paid taxes, it's better to pay something sooner than later. And if you can't pay the amount, it's better to pay something than nothing, since you are reducing those penalties and interest for underpayment here. So obviously it's a very personal situation, but you can make catch-up payments. You can make them anytime in the year. But what you see for the due dates and payment periods is you should have paid a quarter of your expected year liability by these due dates, and that liability is for those payment periods that you're seeing.
Another takeaway here is that if you haven't made quarterly tax payments yet, this upcoming tax payment on September 16th is really the last opportunity that you have until everything is due. So it's like the last opportunity to get ahead, right? And pay into your estimated taxes. Otherwise, if you don't make a payment at this deadline, now everything's going to be due, which is going back to what I was talking about earlier. It's just tough on cash flow, right? It's like a big lump sum that's going to be due all at once. Great. I know we're almost at the top of the hour. I'm happy to stay on as well for a few extra minutes. Want to be respectful of everyone's time. If you have clients here, we will email the recording out. So if you do need to jump, but I'm happy to stay on. We are getting to the end here. So this is the last question. So there's been some questions about penalties and what happens if I don't pay or if I missed a payment. So the way that it works is if you don't make payments by those deadlines, right? There's 4 deadlines. Or if you underpay, you could be charged what's called an underpayment penalty. That starts at 0.5%. So it's literally less than 1% of your tax liability, but it goes up over time. So the longer you wait, that penalty increases all the way up to 25%. And so if you miss a payment, it's best to make that payment as soon as you can, because otherwise, if you wait, it's just going to continue to go up. Not only does the penalty increase, but the IRS charges interest on that penalty. So that also goes up. And that penalty and interest is charged on your outstanding liabilities. So Jonathan mentioned, think about those 4 deadlines as like 4 checkpoints. So by the first deadline, I should have paid 1/4 of my liability. By the second deadline, I should have paid 1/2. By the third, I should have paid 3/4. And by the fourth deadline, I've paid all of my liability. So at each checkpoint, you have the opportunity to like catch up or maybe pay in. If you can't pay the full amount, it's better to pay something because it's going to lower what your outstanding liability is, which lowers the amount that you're charged penalties and interest on. So takeaway here is like, I haven't been saving for taxes. I can't make this payment in this example, right? Like I don't have $7,500 to pay into this quarterly tax thing. Just pay something, pay 1,000, pay 2,000, whatever you have, because that's going to reduce the amount that you're going to be charged in penalties and interest. Sticking with this example, I plug this in. So on $80,000 of taxable income, if I don't make quarterly payments, my penalties and interests is about $1,120 when I file. So it's about $950 from the IRS and $160 from the state of Georgia. So if you remember, we are paying $30,000 in taxes. So we're paying $1,000 penalty on top of $30,000. So it's not like a huge amount compared to what our tax bill is. But if you can save $1,000, that's great, right? You can reinvest that in your business. You can put that towards a vacation. The good news is if you do miss a deadline, you can apply for a penalty waiver with the IRS. You need to show that you have just cause, and you have to make that argument. And then if you have a history of good tax compliance, you're more likely to get that waiver accepted. Also, if it's your first time in private practice or your first year, the IRS tends to be, a little bit more forgiving and understanding. So that is an option, but it's certainly not a guarantee. I mentioned at the top of this webinar, I host a podcast called Her Business School. We had our CEO and co-founder, Andrew Reason, who's way better at explaining this stuff than I am on the show. So if you're interested in like learning more or just getting kind of another perspective on how all of this works, definitely recommend checking that out. It's on YouTube. We're also on Apple and Spotify. We'll send out the deck here so we have the link. And thank you, Melanie, for dropping that in the chat. I know we're over time. Again, if you do have to jump, just want to say thank you so much for being here. I'm happy to stay on and take questions. I wanted to throw this up here again as a reminder. We're offering 50% off our annual plan. So if you're feeling like, man, this is a lot, this is really confusing, quarterly taxes is something that we specialize in at Herd, and we do for thousands of therapists. So we would love to help you with this process. You do get 50% off annual plans. We do recommend scheduling a call with our team first, just to make sure that it's the right fit for you and your business. Absolutely no pressure to sign up. But if you do want to take advantage of this offer, you would just need to sign up by Wednesday of next week, because that September 16th deadline is right around the corner.
Yeah, so we've got a couple of questions in the chat, and I think something that I want to just leave this team with that, Mike, you and I talk about a lot here. Again, these are estimates. This should not be something that, feels like you are having to do your annual taxes 4 times additionally throughout the year. Really, use this as a way to check in on your business as a checkpoint, but don't, don't put yourself in a deep, dark place, stressing over this each quarter. The best thing you can do here is use this as a way to check in on your business, know how you're doing with your cash flow situation, and then make a plan for how you're going to cover your annual tax bill, because quarterly taxes all ladder up to this annual tax bill. So a couple questions that I see here, Mike, if I can just go ahead and answer a couple that I've been seeing.
Yeah, definitely.
I've seen a few here of how do you know if you owe a penalty or interest on those penalties, and can you find out if you are underpaying? Unfortunately, there is not a clear link or portal on the IRS to say, hey, you're underpaying. That's what the annual tax process is for. However, there are calculators out there that you can find, or you can use what is called a 1040 ES or estimated tax form that the IRS provides, where you're essentially doing that mini tax return, where you're checking your math throughout the year. It's kind of similar to, if you're taking a test and halfway through you're like, let me just check my answers. It's really a checkpoint for yourself is what's required here. As Michael said, like that's what we do at Herd. We have calculators 4 times through the year that we actually help you with this process. So we've got you there. But there are other resources out there that can help you do that too. Um, One question, and just a follow up from there as we think through it. You'll know at the end of the year. The IRS will tell you if you have
Right.
underpaid.
You'll get a letter in the
But
mail, basically,
yeah,
like once
but
you file
there's
if you've
also
underpaid.
forms that you can fill out that will say like, do I owe or have I underpaid too much? That, again, those are public out there that you can find them now, but typically you just don't fill those out or file them by the end of the year. And then one question here, I just want to really quickly clarify for Julie. Great question. She said within the example, the fee on the $75,000 quarterly payment would only be about $1,100 if I don't pay, or the penalty on that. Wouldn't that mean I should just not pay that and save the money? I want to clarify here that $1,100 penalty that Michael was showing would be in addition still to the $30,000 of quarterly tax that
Right.
you owe to. So whether you pay them quarterly or not, you're going to have a bill due for them at the end of the year. And if you don't pay them evenly throughout the year, as the IRS is looking for, that's when you would have that additional penalty on top of that. So it's a personal decision of if you want to eat that penalty or not. It's not criminal, again,
No.
to not pay quarterly taxes. You will just owe penalty and interest some additional amounts than what you would have owed if you paid it evenly through the year.
Right. Yeah. And some people may feel like, and I was in this situation as a business owner, I'd rather take the money that I'm making during the year and, reinvest that into my business, or maybe take that vacation that I really want to go on and I'm just going to eat the penalty. I regretted that because it's $1,000, right? Like if you can just stay on top of it, you're not going to have to owe that, right? So again, you're not going to jail if you don't make these payments or if you pay them incorrectly, but you're going to end up costing yourself additional money and avoidable penalties and interest. So again, it's like you'd rather hold on to that money or spend that money on yourself than just giving it to the IRS if we can avoid it.
Um, and I see a question in the chat from Elisa. I'm sorry if I'm not saying your name correctly here, but do we pay annual taxes on top of quarterly taxes? Great question. So annual taxes, think of it as we are thinking and calculating our annual tax bill when we're doing quarterly taxes, and we're just paying a portion of them. What happens is at the end of the year when you're filing your taxes, Michael has mentioned this concept of truing up throughout this the webinar here. At the end of the year, when you file your annual taxes, you're going to go through essentially what do I owe and what do I actually owe because I now have full information on my tax return. And then you're going to look at what have I paid this thus far through the year, and that includes withholdings as well as your quarterly tax payments. The difference between what I owe and what I actually owe in taxes and what I've paid throughout the year is your annual tax bill or refund if you've overpaid. And so I wouldn't think of it as like these are separate things, but quarterly taxes are a way to kind of like evenly pay your annual taxes throughout the year.
Yeah, you're basically paying into your bill that you'll owe, right? By estimating what you think it's going to be. So by the end of the year, ideally, you have your payments that you've made cover what you owe, so you don't owe anything. That's the ideal scenario, like I mentioned. And then if you overpay in those estimated payments, which is why we recommend being more conservative, you just get that money back as a refund.
And I want to quickly just answer one question that came up. Make sure we at least get this in the recording if someone
Sure.
missed it. There was a great question about what is called the EFTPS.
Mm-hmm.
And what's the difference between that and direct pay or I pay EFTPS? Is that a problem? I'm going to have to really quickly Google what the actual acronym is for EFTS. PS, but EFTPS is the Electronic Federal Tax Payment System. If you are paying on EFTPS or direct pay for your quarterly taxes, that is fine. That works for both personal taxes. Quick difference here, there's a small distinction of EFTPS is another federal payment portal. We recommend paying direct pay for your quarterly taxes just to keep it simple, but EFTPS, it's totally fine if you pay there. If you owe some extra special business taxes for things that aren't pass-through income taxes, you'll pay there, but totally fine if you're paying your quarterly taxes there or on direct pay.
Great. We did get a few questions about tax deductions. I mentioned that in September, we're planning a webinar all about how to optimize your taxes, because if you're feeling like, man, 37% is a really high amount, and I'm paying $30,000 in taxes on $80,000 in profit, like that feels like so much in taxes. There are strategies and things that you can do to lower your tax liability. And so can't cover that today, but we're definitely going to talk about that next month, and we'll send an email out and let you know. So make sure that you sign up for that. Great. Natalia, just so really quickly, it's a great tee up for, the next webinar, but when we think about business expenses and tax deductions, let's go back to the example of $100,000, right, in total income, $20,000 in expenses. So the expenses that you have throughout the year, these are your subscription costs, your rent, things like that. Like those are business expenses that lower your net income or your profit or your taxable income from your business, right? So your business expenses are lowering your profit to get to that net income number, which is your total income minus expenses. And when you go to file your taxes, you're able to claim tax deductions and tax credits if you qualify. So that's where you then can get that down further. So think about like business expenses technically are tax deductions because they're lowering what your taxable income is, which is what you pay taxes on throughout the year. And then at the end of the year, you're able to claim tax credits. So Judith, great question here on multi-state. If you're working with Headway or seeing clients from different states, it is helpful to track in your EHR or wherever you're doing your billing, like where these clients are, how much income have you generated from each client and from each state, just so you have like a general sense. I would start by looking at what are the states where you have those clients, and then trying to understand what that nexus is that I talked about. So the state of Massachusetts I mentioned was $8,000, right? So if you think that you're earning $8,000 or more from clients who live in the state of Massachusetts, then that's worth looking into. But if you have like one or two clients who lives in a different state, and you're probably not going to even be close to that threshold. So that's how I would start to think about it. But again, that comes back to like your bookkeeping and tracking your income. And if you're able to track, even roughly like how much income you're generating from clients who live in different states, then that'll help you to better understand if you need to make multi-state payments or not. This is one where it probably makes sense to consult with a tax professional as well, just on your unique situation. This is something that we help therapists with at Herd, just because it's a little bit more nuanced and kind of hard to answer on a webinar like this. Great. Well, we have overstayed our welcome. We've gone way too long. So again, thank you so much. There's 74 people here, which is amazing, who stayed on 15 minutes late. Thank you, Julie, Ashley, Jessica, Victor. Thank you so much for being here. Again, we're going to send out the recording so you can watch this back. Look forward to the next webinar. And with that, enjoy your Friday and enjoy your weekend.